Switching over to the carbon side of things, it really is a continuation of the trend that we talked about last month, which is whether we're looking at China, which is shown in the orange, the blue line, which is North Europe, or US prices, all three of them are heading the same general direction at slightly different speeds, maybe because some moved a little further faster on the upside, but certainly there's a heavy correlation between the direction to the downside as we see it right now. In the last month, we've taken about $100 to $150 out of US hot roll. Europe's about $100, and then probably 50 to $75 out of Chinese hot roll prices. So there has been, on a global basis, with the European slowdown, slightly cooler US manufacturing data, and then I would call underwhelming Chinese data thus far. A lot of these markets that had a little bit of optimism in Q1 and early Q2, they've lost some steam at this point in time. Part of that equation is going to be capacity utilization, which is shown here in this chart, and that is domestic production slightly ramping up. It's not in a massive way, but you can see that since, I'd say, beginning of the year, we've seen utilization go from about 71, 72% up to where we are at 77%. We're still not back up into the multi-year highs of 80 to 85%, but production is coming back online domestically, whether it's from North Star or from other mills just ramping up, trying to take advantage of the higher prices. We are certainly seeing more tonnage available. So if we looked at this on a month-over-month basis, we've added about 1% to the utilization number, which rough estimates, I'd say that adds about 1 million tons annualized for every percent. So it's a fairly decent move in terms of new production coming to the market. I don't have a chart on this. I know we've talked about it in the past. We are seeing imports move up a little bit, certainly not to the extent that I would have expected, but they have crept up a little bit in the last couple of months, just given the fact that there was an arbitrage, there was a gap between where domestic prices went and where foreign prices could be purchased from. And then, as we always do with the steel markets, we like to look at the futures curve. The futures curve is not our opinion. It's simply the market's expectation of where they think prices should be trading. The blue line is 6 months ago. The green line is a month ago. And then the orange line is current, basically as of last night. And it's basically the same shape as where we would have been a month ago, except for one factor. I would say the trough of the curve, as we look at it today, is just a little incrementally lower than where we would have been a month ago. So as we look into late Q3, early Q4, maybe the curve shifted lower 20 or $30. So what that means is there's an expectation prices could go down by a little further than what they would have been thinking a month ago. And I would say there's potentially some reality to that. And the main things I would point to in that would be Europe continues to slow and show some very weak manufacturing data. And the bigger one is China. China is really weighing on the global commodity and industrial landscape to a fair degree. So again, I know I sound like a broken record, until or unless China announces some sort of stimulus package, I think that we've got some headwinds ahead for us.